On March 9, 2023, depositors withdrew or attempted to withdraw $42 billion from Silicon Valley Bank in a single trading day. Historically, bank runs were constrained by physical mechanics. They unfolded over days or weeks because depositors had to travel to a branch, stand in line, and process paper withdrawal slips. A loss of $42 billion in 24 hours usually implies that a bank's assets vanished. Yet on the day of the collapse, SVB's underlying holdings were largely unchanged. Silicon Valley Bank collapsed because it ran out of time, even though its balance sheet remained technically solvent. This mechanism is distinct from the speculative asset bubbles we covered on day 135. While bubbles are about mispricing, a bank run is a threshold of liquidity and collective coordination. To understand how a healthy balance sheet can be destroyed in a single afternoon, we have to look at the structural mismatch built into the very foundation of banking. This is maturity transformation. Banks take instantly withdrawable deposits and transform them into long-term assets. Because money is locked in assets taking years to mature, the cash reservoir is small. The system handles daily withdrawals, but cannot survive everyone asking for their money at once. Picture a startup founder checking her phone on a Thursday afternoon. She sees a group chat where other founders are mentioning they've moved their company payroll out of the bank just to be safe. She is now standing at a threshold between two realities. In reality A, she believes the bank is stable. Waiting costs her nothing, she leaves the money alone, and the system continues to function. In reality B, she expects that everyone else is about to withdraw. Because banks serve requests on a first-come, first-served basis, waiting becomes the most dangerous move she can make. She runs to the exit simply to avoid being the last person in line. This is the Diamond-Dybvig model, which earned the Nobel Prize in 2022. It shows that both realities are stable, valid outcomes for the exact same bank holding the exact same assets. The only variable that decides if the bank survives or collapses is the invisible expectation of what other depositors are about to do next. SVB's catalyst was a portfolio of U.S. government bonds, historically the safest assets in the world. But as interest rates rose rapidly through 2022, the market value of those bonds dropped, creating massive unrealized losses on the bank's books. This risk was magnified by the nature of the depositors. 90% of the bank's funds belonged to venture-backed companies with balances well above the FDIC insurance limit. For them, a bank failure meant total financial ruin, not a protected inconvenience. This depositor base was also uniquely networked. They shared the same investors and communicated instantly through private channels, allowing a single spark of concern to saturate the entire network in a few hours. Mobile banking removed the physical speed limits that once slowed bank runs down. Depositors no longer had to travel to a branch. They could execute a billion-dollar withdrawal from a phone while sitting in a meeting. SVB failed because modern technology allowed a coordination panic to execute at a speed that outpaced the institution's ability to respond. To understand the aftermath, we have to distinguish between solvency and liquidity. Solvency is a question of the total balance sheet. Do the bank's assets, if held to maturity, exceed what it owes? Liquidity is more immediate. Can the bank convert enough of those assets into cash fast enough to meet the demand hitting it? To meet the run, SVB was forced to fire sale its bonds at a steep loss. This forced sale process converted what began as a liquidity crisis into actual insolvency. We have just crossed the halfway point of this 10-part arc. If you're following the series, now is the perfect time to subscribe, so you're here for the final 5 thresholds. Economists still debate whether this collapse was a rational response to SVB's bond management or a self-fulfilling coordination panic. There is evidence for both, and the two mechanisms likely reinforce one another. When regulators stepped in to guarantee all deposits, they were directly targeting the Diamond-Dybvig dynamic. By ensuring no one would lose money by waiting, they removed the incentive for other depositors to run. This mirrors the mechanism of buy stability we saw in the coral reef episode on day 143. Both systems can settle into two wildly different realities based on the exact same starting conditions. Tomorrow, we move from financial thresholds to physiological ones. Day 146 explores the metabolic limit behind the endurance sport bonk. In banking, confidence is a load-bearing threshold. It is a resource with no reserve requirement, and once it is crossed, the math of the system rewrites the reality of the institution.
Thank you for sharing this moment of pure wonder. You are the true magic that fuels this journey. Until next time, remember to shine bright.